Background was I was a traditional finance guy. I caught the wave in the 90s, which was a fantastic wave. I was involved in the derivative market and then the rise of the hedge fund business. So I was a salesman at first, working for many of the largest investment banks, ended up in Goldman, starting and co-running the hedge fund sales business in equities and equity derivatives. So I got to speak to the most famous hedge fund managers in the world on a daily basis. I was the guy in Europe, and it was a very fantastic opportunity to learn from the best. I then decided I'd learned and I now wanted to make some more mistakes. So I then went and joined one of my clients, which was the largest hedge fund firm in Europe called GLG Partners. And I started, first I started running a book, and then having made plenty of mistakes, I then figured out what I needed to be doing, and then launched and ran the global macro hedge fund for them for several years. Then decided the hedge fund business was not the business that I wanted to be in any longer, because it was now becoming an asset gathering business as opposed to a performance business. And I decided to opt out of the rat race, move to the Mediterranean coast of Spain and live in the middle of a national park 5 minutes from the beach. And I did that for 10 years, writing Global Macro Investor, which is my flagship research product, which really was, I started it just to keep my hand in the game, pay some bills, keep the hand in the game for the world's, best known hedge fund managers, because they're all kind of people I grew up with. And I had probably more experience in the hedge fund space than any other person writing at the time, any research. Most people either came out of investment banks as research people, or they just came out of the newsletter world. So I was one of the rare people who had been running money, knew that whole business from start to finish. And so I still write Global Macro Invest to this day. So that's 16 years later. It's still one of the preeminent macro research services in the world, and still read by the world's most famous hedge fund managers, sovereign wealth funds, family offices, stuff like that. And then somewhere on that crazy journey in Spain, having watched the world almost collapse twice, 2008 and then 2012 in Europe, when we almost lost all the European banks and Europe itself. I was at the epicenter of all of that and knew exactly what was going on. But friends of my parents and friends of friends didn't. And they would come up to me and say, well, why didn't we know? And I'm like, this sits really uncomfortably with me. Why do some people have all the information and others have none? So that got me on the journey of thinking I wanted to do something about it. And somewhere down the line, 3 of the co-founders lived in the same village in Spain, same town in Spain. Over a few drinks, we started coming up with the idea. The 4th co-founder, Grant Williams, happened to be in Spain. I didn't know him at all. He had made a couple of videos, and we thought, you know what? Video is going to be the answer. This is very early still in video world. Video is going to be the answer. So that's what we started. And, I don't think you guys would exist without Real Vision. I don't think any of the podcasts would exist without Real Vision. Half the things, Real Vision was the start of it all, of democratizing the very best financial information. And still to this day, we have the most incredible roster of guests and people that nobody else can get. That just helps people understand what the hell is going on. It helps them understand the complex world of kind of finance, business, and the global economy, and how it all interacts. And, we've moved also into crypto, because, that's been part of this journey too. And crypto and macro are now the same thing. It just means we've all got a lot to learn. So all the crypto people have got to learn a lot about macro. All the macro people have got to learn a lot about crypto. So it's a fun time as well. So yeah, that's basically the story. I live in the Cayman Islands. So I moved to the Cayman Islands back in 2014. We set up Real Vision here, and I live between 2 islands, a small island of 140 people called Little Cayman, and the big island, Grand Cayman, of about 60,000 people, where I am today in my office. Usually what happens is there's a realization that economic growth is about to disappear or has disappeared. That's when everyone goes, oh my God, sell everything. I don't know what to do. That's the liquidation phase. We saw that last March. This time last year, we were middle of the liquidation phase, right? Just panic, sell, get out. I need to assess what's going on. Then you normally have something called the hope phase. The hope phase is, you know what, it's going to be all right. Now, normally, that hope phase usually goes on for 3 to 6 months and then fades because the reality sets in. And in a credit crisis, much like this is part credit crisis, because businesses couldn't generate money, people couldn't pay their debts. Normally speaking, the insolvencies, the bankruptcies rise, and then you get the next wave as all the unemployment comes, etc. But this one actually played out differently because the central banks and governments were so aggressive. We've never seen anything like this in all history, that it stopped the insolvencies because they just gave people money, said, don't go bust on me, please don't go bust, here's some money. It was for businesses, you can borrow money, you don't have to pay us back. Individuals, I don't care what happens, here's $1,500 or whatever the number is, right? So that has either stopped the insolvency phase, but you've transferred those debts to the government and the central bank, or it's delayed it and we've got more to come as people realize that retail jobs, for example, are probably never coming back. So the crisis, so it has changed compared to a normal crisis, but that's the important thing when we get to that mix between macro and crypto. We've learned now that interest rates, which were the usual mechanism to stimulate the economy, I cut interest rates, you might borrow some more money, or your mortgage payments go down, so you've got some more money to spend in a restaurant. That's the basic mechanism. Or you can spend more on your credit card. But interest rates were zero anyway, basically. So then the only answer was this monetary printing that we see, quantitative easing. And that's a weird old mechanism because you don't get it. It's not like somebody says, oh, look, we just put, $10,000 in your bank account. You're like, how does this all, where do I get it from? You actually go and borrow, it's no easier. So it's a weird world, but there is a mechanism by which that finds its way into asset prices. And I'll explain a little bit about that in a sec. And things, go up in price, things get more expensive. And the idea is it also allows people who need money, like big corporations, to get the money that they need. So that also, the flip side of what sounds like an amazing piece of magic has another negative side, is that piece of magic is actually the creation of more money. So let's say you were really thirsty and I gave you a bottle of water. You'd pay me pretty much anything for it. Let's say you just come out of the desert. Let's say you're not ordinarily thirsty, maybe 2 small bottles of water, you're replete. Now, if I give you 1,000 bottles of water, you don't really want them anymore. So you won't pay for any of that water because there's too much water. It's the same with all assets. If there's too much of it, it becomes free in value to you. So we've seen that, for example, in music. Music has become essentially free. The same is true of money. What happens is, if you create more of it, it's not like we all get richer. If we all get richer at the same time, we're all going to pay more for that restaurant meal because we all have more money. So what happens is the value of money falls. And that is where the macro of this huge recession based around the most indebted economy the world has ever seen, which is the US, in this global indebted world with an aging population and a bunch of millennials who have gone into the labor force with massive debts, which is very difficult for them.